Over the quarter, much of the weakness that we have seen emanated from the developments in the US. Only once we dissect the 10-year US bond yield can we see what is happening. Real yields in the US have been on an upward trajectory due to repricing upwards of growth prospects relative to initially far too benign assumption base. We have long held that South African bond prices are mainly driven by what happens offshore, and what we are currently seeing is no different. Local bonds have been moving higher as they price in the US yield curve repricing higher. Given the strong growth prospects and resilient consumer in the US, ordinarily this would be met by US and foreign capital seeking out high-yielding risk assets. However, this has not been the case to date, given that the Fed is able to keep policy rates higher for longer, considering that the US economy is well on its way to a soft landing. As long as the treasury rates at the front end of the US curve remains elevated, this creates a high hurdle rate to scale before capital will look for yield elsewhere. In terms of the positioning for the quarter, we have favored the belly of the curve, particularly the 2035-2037 area, which offers a good yield and a strong roll down. As the sell-off deepens over the quarter, we incrementally look to add more exposure at the back end of the curve, effectively adding duration and convexity at a time when our level of conviction of the entry point has increased. We expect the process of disinflation in key developed markets such as the US to continue gaining traction. This will ultimately result in a repricing of the front end of the US curve and ultimately lower the opportunity cost of capital leaving the US. This will be a positive factor for high carry destinations like emerging markets. Historically, South Africa has been a key beneficiary of these dynamics.